So we are right after a very important gauge for US economy. It is CPI that is at lower level than the interest rate. So we are entering a cycle of positive real rates. So it's typically bringing for US economy a better outlook for the next few months than it was back in the beginning of the year and the last quarters of the 2022. But purchasing power of US dollar still decreasing. CPI still remaining dangerously high. And what has it been affected by? There are many rumors that the gold has been flowing west to east rapidly lately. And this negative spiral may only increase. That's why the gold is rising as one of the hedge against the problems. While the downward trend in inflation is likely to persist, trajectory is still in question, and right now the Fed would observe it, how other data beyond CPI may look like. For now, however, the markets are expecting that Fed will pivot on June's meeting. So what will it bring for us, for investors, for traders? That's all about in today's episode. So I'm very glad you decided to pop in, and let's head on to first block of Blockrevision today live. Alright, economy view is the first one to discover. So we are jumping to short-term treasury yield curve showing risks. So Fed's preferred recession rate spread indicator, a 3-month to 18-month forward, is now flashing red, implying a 94% probability of a recession within the next year. So this so-called Powell's curve is right now skyrocketing, hitting new highs that were with precedence back merely once upon this time, and it was back in 2000s, right before the recession was been accelerating. So frankly speaking, right now, if we just observe that curve, there is a good research and the good outcome for what the future may bring over. So the yield curve right now is indicating that we cannot really hinder from this turmoil, and a game of chicken with financial market turmoil as leverage piling up is more likely to unfold, especially with this low liquidity outlook. So when will be this Minsky moment come up? So for now, we are all observing the corporate credit risks. To be honest, recently those fears of having another demise of banks has been faded away, but there is still prolonged situation that is still like swept under the carpet rather than being cured in a kind of a reasonable way. The outlook is moreover undermined by US. In the US, it should be the fact that small business optimism falls to lowest level in a decade. So that brings over also some other concerns such as consumer spending that may deteriorate as and this spending consumer is one of the most important factor that adds up to these problems of small businesses, alongside a lack of confidence among small business owners can also ripple through the economy, affecting sentiment among investors and other entities. So those are the facts we cannot skip that will dwindle upon the economy, and we need to just be prepared for the times that may be a much bigger headwinds that are right now. In terms of government interventions, however, when this turmoil will happen, the government interventions will definitely take place as by studying recent 15 years on the financial markets. So the government will be the first entity to rescue the, I don't know, zombie companies or other useless entities that don't have any profitable way to find its performance on the market. So taking that point, let's study together what was the impact of government interventions to cumulative economic growth. And it's right now we can find that there is a disproportionate impact of given this fiscal stimulus and the results that were just observed in a GDP or other economic growth gauges. So that was also back in 2008 when there was study regarding whether the government intervention helped to stand this economy after this turmoil, and it was just a short-term I would say injection into the market when the market has started to believe that everything would be fine, but it was small and medium cap companies that were tried to rebound out of this economic trough, whereas the largest pile of money has been strictly moved to the large companies. So it's rather, I would say, the economic vehicle is basing on small and mid-cap companies that are just the engine of the economy rather than a large one. And this fiscal stimulus is obviously more rather more than less in less type of cases is just been transmitted to the larger entities. So aside of inflation, there are not many other elements that is and are impacting the market to a large extent. Jobs market standing still. Right here you can find US non-farm payroll on blue and US unemployment rate. So US unemployment rate is dropping, whereas non-farm payrolls are rising. So it means this divergence usually are the harbinger of a rebound during next sessions, next reports. So possibly the May's one correlation should be positive. That the one that we'll find out on June's reports that was also back seen in August 2022 when we had those gauges that also coincided that type, and it also brought positivity to the market, and it has also overlapped with a positive moods on at the market. So there may, I would say, sell in May and go away should be right being I would say marginalized phrase, as this time might be over. This time might be different. Sorry. The Oracle of Omaha shows we can do it. So he can so he is buying Berkshire stock as he repurchases regarding the headwinds possibly over, and also Berkshire cash and short-term investments has risen. So there are some type of I would say divergences between what the Oracle of Omaha is saying, I mean Warren Buffett, and what exactly he is doing. So the billionaire from Omaha is right now expecting that this government will backstop his TBTF investments, unlike those of pretty much anyone else. And the head of Berkshire Hathaway had a far more downbeat and gloomy prediction for his own general. The good times might be over, he said. So billionaire investor said he expects earnings at the majority of the conglomerate's operation to fall this year as the coming economic downturn slows corporate activity further. But we are heading to Bank of England that is about to decide this Thursday, but we need to reassess this one as whenever we started to predict the next level of interest rate hike, we typically miss. That's why whether this time will be the surprise for the market and the volatility on a GBP currency pair will spike right after. Possibly yes. So right now we observe that there should be another increase, but about how far it would be, it is about to turn out tomorrow, and we are strictly, slowly but surely starting to reach the level in rates where cash becoming a king. All right, so market outlook is the one I wanted to find out. So we are right after the market open. Today's transmission is a bit I would say shifted in time. So right now, after market open, we are trying to find liquidity after this CPI gauge in order to make another rally forward. This path of least resistance, despite this rising wedge being formed, is upside, as this chart is in a congestion zone where those highest points of liquidity and that's where the price is concentrating, is underneath, building a floor and possibly building a ramp up to push the valuation upwards. So right now we are correcting the CPI report gauge, but if you are just have missed the mark, have missed that spike, you may catch on the train right at the levels of 13.25, or even right here. I would bet that won't be a much of a bad bet to take up to the upside. Possible objective for this type of formation is at around 13.76, and should stop somewhere right there at those levels. We may even head on even much further, but for now the one inflection point that is bothering me is exactly this 13.35 that also been a kind of a strong resistance back in April and May of 2022. So I would set my objective at first of at around 2.29% higher than we are right now. So that's out of major indexes. So bears right now saying goodbye, and with this CPI reports and this doubts of having this much hawkishness on the next Fed's meeting should fade away. So that's out of major indexes smells a short squeeze. That's hedge funds record short treasury future positions, and by the time where this consensus on the market been achieved to that extent, where those short positions are piling up, normally the narration doesn't conceptualize, and Mr. Market is doing everything to shift the ratio, typically by large swings up or down. So that's why you better steer clear out of that positions, as it's much of a overcrowded, and typically when it's not only overcrowded but extended in terms of price action, typically it moves in a other direction. So this pessimism against bonds has been outstanding, but when it went far upside, it doesn't mean it cannot go further. So State Street right now is still very bearish. That's why also that will justify that the path of least resistance is upside. So right here you can find also another divergence that may spark some doubts on the further rally. That's the one of the obstacle why those indexes, in my view, are not looking that strong, as the Russell 2000 still hasn't started from the base, whereas S&P 500 is thriving. Let's quickly find out what's going on with DJI, and it's more like, right now we are still inside of this large descending triangle, and right here we still are awaiting another spark upwards. With this risk appetite, the US 100 is likely to thrive, whereas DJI may be a laggard in this environment. So that was it in terms of crypto outlook. Let's find out what we have right here. It's a comparison of Ethereum from where it was back in 2022. So we can find this second world altering protocol that's gonna, I would say, replace many of big banks, is showing a burning type of supply. So with a usage of a protocol, this Ethereum burns if it's been used on a larger scale. The pace of a burn is even much more accelerated to the upside. So I would say that recent much more circumspect outlook in the options market may right now affect Ethereum, where many of option traders are expecting that Bitcoin will rather remain within the levels of 30 to 32,000, but there is more like a more shift to the downside type of an outlook after recent price rejections. Those negativity on the market has come up, but if we just have a look into what those markets are telling us by price action study, 1 second, sorry for that. I need to just quickly switch on the windows, and if we just have a insight in what's going on in Ethereum, right here we can find we started to build a floor that right now is unbreakable. We are rebounding out of the stronger and stronger power to the upside, and for me, Ethereum to USDT right here is the one possible candidate for that to touch another important level of 2,378 and maybe stop right at 2,500. So for me, after building that floor, after building this power to make another leg upside, we may see another around 30% move right in the north direction. So Ethereum USDT is the one that right now is defending itself from drowning, and the liquidity that been built underneath is the one that should push it upwards. So what we have next, market movers, and that's the projection of the one before the inflation rate has shown us 4.9%. So that need to be updated, but I want you to show the overall tendency. So the analysts are expecting that inflation rate should be drawn down, but we are at the pace where this inflation rate is slowing very, very, I would say, in the very insignificant pace, and this core inflation rate still is nagging many analysts. So core inflation rate for us is even more important, as we do know that even though the energy prices and food are slumping, the core inflation rate is this wider type of a inflationary gauge, and if that won't diminish, we will have a serious problems for the economy. So such elements as costs related to rent and transportation should take a slow, pushing the overall core figure. But right now, this core goods inflation may spike higher in the next months. So we need to update our view on that relatively. In terms of this earnings week and the next data will be the Walt Disney, the Trade Desk, Unity, Allegro, Ginkgo, Bioworks, and Beyond Meat, sorry. And right here, if we just switch on to earnings calendar, right here you can find that for this week, maybe for yesterday, Airbnb has slided with EPS, but its revenue has rebounded, so it brings much more positivity for leisure type of sectors, whereas Occidental as one of them. As a product of a lowering demand on gasoline due to high prices, has suffered recently. In terms of today, we have Walt Disney, Crédit Agricole already published that was better than expected. Toyota Motor also better, but still on tomorrow's date we are awaiting Merck, Bayer, and other type of companies related to biopharma and medicine sector. So in terms of economic calendar, let's find out quickly what we have right here on Wednesday. Maybe let's find out. So yesterday we had Fed Williams' speech that was at a medium type of hawkishness, but after CPI, he could say probably more. So I wouldn't take it as a one of a harbinger for what may come next. For now, the more dovishness should be brought over to the table. Tomorrow we obviously have at 7 a.m. Bank of England interest rate decision, but those are the most important things to watch. And on Friday, GDP growth rate. So